Scott, I think when we go back to February when the market was at all-time highs, we have to keep in mind we had a lot of uncertainties ahead of us, and we weren't necessarily looking at 2026. The tariff visibility is much better today than it was 3 months ago. And when we look at 2026, I think that there are things to look forward to, such as deregulation, tax cuts, and actually a Fed that's on hold now, but probably doing more cuts now in 2026. And then from a company perspective, companies survived, I think, a black swan event. That waterfall decline in equities and the sort of the near heart attack of the economy still was an environment where companies produced earnings that beat expectations. So this is the fifth stress test for businesses. When I put all that together, I think PE's probably going to be higher in 6 months than lower. And when you think about 2026 earnings having upside, I think there's still upside for stocks.
Tom Lee is right 90% of the time, at least, and well-grounded with the market dynamics. He was the guy on CNBC telling everyone to buy during the COVID crash, while all the other talking heads were panicking and predicting doom. He's the guy who called the tech rebound in 2023, the Bitcoin rally, and the everything rally before it even started. The only big miss? He's been pounding the table on small caps since last fall, and, well, we're still waiting on that one. But here's the thing about Tom. He always says buy at the top, crashing, and at the bottom. If you always say buy, you'll eventually be right. After all, the market goes up about 70% of the time. And yet, so many still believe Tom Lee knows more than everyone else on Wall Street. But the real question is, when is the right time to buy? And how do you make the most out of the market when you do? In this video, we're breaking down some of the key fundamentals and data behind what's really driving this market. From big tech to inflation to the Fed. This isn't financial advice. Please do your own due diligence. All right, let's dive into our first stock, Celestica Inc. ticker CLS, a name I've covered before on this channel, and one that just keeps showing up on growth investors' radars with over 40% in recent weeks. Celestica is a global leader in supply chain solutions. With operations across North America, Europe, and Asia, they support end-to-end services, from product design, component sourcing, and complex mechanical assembly, all the way to logistics, repair, and aftermarket support. The company operates under two major revenue segments: Advanced Technology Solutions, ATS, serving aerospace and defense, health tech, industrial, and capital equipment markets, 30.5% of Q1 2025 sales. Connectivity and Cloud Solutions, CCS, supporting major names in cloud and enterprise like IBM, Dell, Meta, and HP Enterprise, 69.5% of Q1 2025 sales. Celestica's market cap stands at $10.67 billion, and it's currently trading around $109, which is 21.9% below its estimated fair value of $149 based on cash flow models, signaling possible undervaluation. Despite a slight decline in net income for Q1 2025, revenue surged to $2.65 billion, up from $2.21 billion last year. And over the next 3 years, earnings are expected to grow at 23.47% annually, crushing the Canadian market's average of 13.7%. Cash flow growth? It's strong, 34.1% year over year, compared to an industry average decline of 12.4%. Historically, their cash flow has grown at 22.4% annually over the past 3 to 5 years. Celestica is going head-to-head with big industry players like Jabil, Flex, Hanhai, and Sanmina. While competition is fierce, Celestica's engineering and manufacturing capabilities are helping them carve out a serious position, especially in CCS. However, they're not without challenges. Elevated inventory in the industrial segment is slowing ATS growth. Plus, Forex volatility and global macroeconomic headwinds remain concerns. Let's talk returns. A $1,000 investment in Celestica back in May 2015 would be worth over $7,900 today, 18 May 2025. That's over 790% return, not including dividends. To compare, S&P 500 grew 170%, gold appreciated 160%. Celestica has absolutely crushed it in this time frame. EPS is expected to jump 30.2% this year, more than double the industry average of 16%. The historical EPS growth rate? A massive 40.7%. No downward revisions in 2025 earnings estimates over the last 2 months, and in fact, 3 upward revisions. That tells us analysts are getting more bullish, not less. Anyone can invest, but building a successful portfolio takes research, patience, and a little bit of risk. Celestica checks a lot of the right boxes: strong earnings, undervalued price, powerful customer base, robust cash flow growth. But with competition heating up and macro pressures looming, it's critical to stay updated. Again, this isn't financial advice. Please do your own due diligence before investing in any stock. Now, let's move from traditional tech into digital finance. And I'm talking about a name making major headlines this week: Coinbase global ticker, COIN. Coinbase, the largest US-based crypto exchange, is officially set to join the S&P 500 before markets open on May 19th, replacing Discover Financial Services after its merger with Capital One. Now, yes, the stock popped plus 9% after hours on the news, but this isn't just a one-day headline. This is potentially a major inflection point, and for investors, a chance to get ahead of what could be a longer-term price appreciation wave. Why this matters for the stock. Joining the S&P 500 is more than a badge of honor. It's a catalyst. Here's why. More than $15 trillion in assets track the S&P. Over $7 trillion is benchmarked directly. So when a company like Coinbase gets added, passive and active managers are forced to buy. Juan Leon from Bitwise estimates this could trigger up to 7x Coinbase's daily volume in institutional buying. That's not noise, that's fuel. This move also signals something bigger. Crypto is entering the mainstream financial system. Coinbase becomes the first pure-play crypto company ever added to the S&P 500. That's huge. It forces institutions, including those that have avoided crypto, to now hold indirect exposure to it through index funds, ETFs, pensions, and model portfolios. To qualify for the S&P 500, companies need 4 consecutive quarters of profitability. Despite crypto volatility, Coinbase met the bar. And here's what's helping. Bitcoin is now above 100K. Trading volumes are surging. Coinbase earns transaction fees on every trade. That's a formula for strong cash flow. Yes, 2025 YTD performance is still down about 17%, but the company has shown operational discipline, cut costs, and leaned into institutional demand. Coinbase is standing right at the center of 2 powerful trends: the institutional adoption of blockchain tech, rising investor appetite for alternative assets, especially as inflation lingers and fiat trust declines. Whether it's crypto ETFs, central bank digital currencies, or enterprise-level blockchain integration, Coinbase is morphing from a trading app into the next-gen infrastructure for digital finance. Coinbase stock just surged to $265 after our last video, up nearly 30%. If this momentum continues, a retest of its 2021 highs around $357 is very possible. And unlike many crypto-related stocks that are purely speculative, Coinbase has scale, regulation, and real revenues behind it. That makes it a unique play: part tech, part fintech, part exchange, and now part of the S&P 500 elite. Coinbase is more than just a crypto exchange. It's becoming a financial backbone for digital assets, and its S&P 500 inclusion could mark the start of a major value unlock. If you're looking for asymmetric upside with exposure to both tech and finance, and you're comfortable with some volatility, then Coin might just deserve a spot on your watch list. Now let's talk about a stock that surprised the market with better-than-expected results, but still trades like it hasn't earned a seat at the table yet. We're talking about Rivian Automotive, ticker RIVN. Rivian delivered a better-than-expected Q1, beating EPS estimates by a wide margin, a 0.41 loss versus Wall Street's expected 0.76 size. Even more significant, the company posted its second straight quarter of positive gross profit, $206 million. That milestone triggered a massive $1 billion investment from Volkswagen, set to close by June 30th. That injection, combined with $8.5 billion in cash, gives Rivian some serious cushion. It's starting to look less like a speculative EV play and more like a maturing growth story. Despite the win, Rivian's stock ended the week flat. Why? Management cut its full-year delivery guidance to 40,000 to 46,000 vehicles, down from the earlier 46K, 51K forecast. The reason? New U.S. tariffs on imported EV components, especially batteries and semiconductors from Asia. This could add thousands of dollars in production cost per vehicle. On top of that, Rivian is increasing its capital expenditure forecast to as high as $1.9 billion, reflecting both the higher input costs and strategic retooling plans at its Illinois factory. Make no mistake, Rivian still faces major challenges: supply chain vulnerabilities, 5B+ in negative free cash flow over the last year, rising competition from both legacy automakers and startups, execution risk ahead of the 2026 R2 model launch. A one-month production halt later this year for factory upgrades will also temporarily slow output. Still, it's a smart long-term move. Right now, Rivian holds only 2.9% of the US EV market and just 0.23% globally. Compare that to Tesla's 50% share in the US, and you can see why Rivian is still an underdog. But that also means room to grow. In Q1 alone, Rivian delivered 8,740 vehicles and is guiding toward up to 46,000 this year. Still small, but trending upward. Valuation-wise, Rivian trades at 2.5x sales, far below Tesla's 9.5x. For a company not yet profitable, it's still a premium, but more palatable when you factor in a $6.6 billion DOE loan for expansion, a major strategic partnership with Volkswagen, a long runway for capturing EV market share, as the US targets 26% EV adoption by 2030. Right now, the street is cautious. Out of 25 analysts, the average price target is $13.80, which implies slight downside from current levels. This is not a momentum play. This is a high-risk, high-reward contrarian bet. But for long-term investors who can stomach the volatility, Rivian may offer real upside, especially post-2026. Rivian's not perfect, far from it, but operational progress, improving margins, and a billion-dollar vote of confidence from Volkswagen signal it's moving in the right direction. This is a patience play. You'll want to monitor quarterly delivery trends, gross margin improvement, cash burn trajectory as it heads toward profitability. So there you have it. Celestica with growth and cash flow strength, Coinbase joining the S&P 500 and legitimizing crypto, and Rivian quietly laying the groundwork for a breakout, if it can execute. Which of these stocks are you buying, holding, or avoiding? Let me know in the comments below. And if you got value from this breakdown, be sure to like, subscribe, and hit that bell so you never miss a market insight.